One day in Coin City, Jack decided to visit the local bank to ask about a loan for a new house in the suburbs. Jack had spent years saving money, but he still needed to borrow 200,000 coin dollars to afford the home his family had always dreamed of.
When he met with the bank officer, he was told that the current mortgage interest rate was 8% per year. Jack was surprised because only a few months earlier, his friends had told him that interest rates were around 6%. On his way home, Jack stopped by Sarah's bakery and shared the news about the unexpected increase.
Sarah sighed because she had recently borrowed money to buy a new industrial oven, and her interest expenses had risen significantly.
Together, they decided to visit Old Benjamin and ask why banks would suddenly increase interest rates. Old Benjamin smiled and invited them to a hill overlooking the busy skyline of Coin City.
Pointing toward the crowded streets and thriving businesses, he explained that the city's economy was growing very rapidly.
People were spending more money, businesses were expanding, and demand for loans was increasing across the city.
Mike, the owner of the largest construction company in Coin City, had recently borrowed millions of coin dollars to build new housing developments.
When too many people borrow money at the same time, the amount of money circulating throughout the economy grows quickly.
As demand rises, the prices of bread, gasoline, construction materials, and many other goods begin to increase.
Mr. Coin, the governor of the coin bank, noticed that inflation was starting to appear and needed to be controlled. To slow things down, he decided to raise interest rates.
When interest rates increase from 6% to 8%, borrowing becomes more expensive for households and businesses.
As a result, many people think more carefully before taking out loans for homes, cars, or business investments. This naturally reduces the pace of borrowing and spending throughout the city. With less money chasing the same goods and services, prices have a better chance of stabilizing. Raising interest rates is similar to applying the brakes to a car that is speeding down the highway. Jack began to understand that banks do not raise interest rates simply to make life harder for borrowers.
Instead, higher rates help keep the economy balanced and prevent inflation from getting out of control. A few years later, however, Coin City faced a completely different situation. Several businesses struggled, and many workers saw their hours reduced or lost their jobs. Consumers became cautious and started spending less money than before.
Sarah noticed that fewer customers were visiting her bakery each day.
Mike also postponed several construction projects because demand for new homes had weakened.
Seeing the slowdown, Mr. Coin decided to lower interest rates from 8% to 4%. Lower interest rates made borrowing cheaper and encouraged businesses and families to take out loans again.
For example, a loan of 100,000 coin dollars that previously cost 8,000 coin dollars in annual interest would now cost only 4,000 coin dollars. Because borrowing became more affordable, Sarah purchased new baking equipment, Mike restarted construction projects, and more residents began buying homes. Jack finally realized that banks and central banks raise interest rates when the economy is overheating and inflation is rising too quickly. He also learned that they lower interest rates when economic activity slows down in order to encourage borrowing, investment, spending, and job creation throughout Coin City.